Okay. Now the argument is, I said, do derivatives make risk capital available? I said, if they do, it's good. If they don't, hey, it's in trouble. Now I'm going to show you how in the agricultural markets, how derivatives make risk capital available. Take a commodity like, say, wheat. In the US, wheat is planted around maybe April, May, and is harvested around August, September. Now, when the wheat is harvested, somebody has to carry that wheat for consumption throughout the year. That's not the farmer's job. They have grown the wheat, now they are out of it. Who does the storing? The big grain companies. Continental Grain, Bunge, Archer Daniels Midlands, they do the storing of wheat. Okay, now the grain merchants are going to have to bear all the risk now. They are paying the farmers around August, and they're carrying the wheat for consumption throughout the year. Prices might go up or down the road, and they're going to be in trouble. The grain merchant says, no. We don't want to take that risk. We want to be paid for storing that wheat. So what do they do? They look up wheat prices which are quoted in the futures markets, and there are quotations for wheat. You can buy and sell wheat for December delivery, March, May, etc. They look at those prices, and let's say they figure out from those prices that they can sell the wheat on average for about $10 a bushel. The grain merchant look at the prices. So what they do next? They tell the farmers, hey, we will buy a wheat for $9.50. And we'll guarantee you $9.50 right now. And the farmers might complain, but they might, let's say, agree on $9.55. The moment the farmers deliver the wheat, or the moment the agreement is made, they will call up their traders in Chicago and say, sell the wheat for $10. Sell the wheat for future delivery for $10. Now they bought the wheat for $9.50. They made a commitment to sell it for $10. They've guaranteed themselves a 50-cent margin. They don't want to take that risk. So who takes all the risk? The speculators in the markets. They're on the other side. Those guys who think that they know wheat prices down the road. Now, but the important thing over here is that now when the farmers want the money to plant the crop, the banks will say, hey, I want to see you guys have a commitment to sell the wheat. And they say, hey, we've got the grain companies. Have a way to buy the wheat from us. And the banks will give them loans. So see, the loans, the risk capital becomes available because the derivatives market now, in this case, has hedged the risk. See, now the hedger over here is whom? The grain company. The grain company has bought the wheat and immediately hedged it. Now I've asked you, did the grain companies do this for the sake of getting rid of risk? That's another whole thing. If you look at the definition of hedging, look at Wikipedia. What do you see? Hedging is a transaction undertaken to get rid of risk, to reduce risk. The grain merchant over here didn't hedge to reduce risk. He hedged to make a profit. In the process of hedging, risk was reduced. But he didn't hedge to reduce risk. He hedged to make a profit. That's the difference between the agricultural folks and the financial folks. The finance folks say we hedge to reduce risk. If you tell a grain merchant that, he'll laugh at you. I'm not here to do that. I'm not taking on risk to hedge it. I'm taking on risk because I can hedge it. And if you know what the definition of an arbitrage transaction? An arbitrage transaction is I'm buying from Andy and selling it to you immediately. And when I do that, why am I doing that? To make a profit. And in the process of doing that, risk is reduced. But I'm not doing it for the sake of reducing risk. That's the major difference. Then I said, of course, again, I proceeded over here. These guys took on, they passed it to the futures market, to the speculators. Okay? And finally, the consumers. Now, the end result of all of this is the bread is much cheaper than it would have been. And just to show you what price of bread would have been if this market was not there. This market to pass on the risk. Now the grain merchants would have to pay the farmers and we're taking on enormous risks. So they would tell the farmers, okay, hey guys, now I can't pay you, what do you call, $9.50. I have to pay you $9.40. And they have to sell it for a much higher rate. And it would sort of trickle down all the way. This would become much more expensive at this end of the game. But these futures markets basically make the bread much cheaper than it would have been. Look, that's how in this market, derivatives make risk capital available. Okay. Now hedging versus speculating. Now, this has also become a problem. Now I showed you exactly what hedging was. I read once in the Wall Street Journal, United Airlines loses $600 million on fuel hedges. What's going on over here? What's the hedge here? How are you losing $600 million on a hedge? And Vera Sun files for bankruptcy on ethanol hedges. Now, if it's a hedge, how can you lose money? Now, this is the misunderstanding of what these guys were doing. This is what United Airlines did. Remember when the price of oil went up to $140 a barrel? United Airlines was in a squeeze. Price of going up, going up. Finally, when the oil price reached 110, they said, we can't take this anymore. Let's go into the market and buy oil, buy fuel at the price right now, 110. And they said, now we fixed our price, okay, we are hedged. The price of fuel went up, 130, 120, 125, 130. They were very happy. We bought our oil for 110. What happened next? Oil took a turn, 144, started coming down, down, down. Now they look at the prices, Jesus. It hits 110, 900, 90, 80, 70, all the way down to 35. And they made commitments to buy it at 110. And they thought they were hedged. They were not hedged, they had fixed a price. You're lucky the prices go up, you're happy. Prices go down, they got killed. And they thought they were hedging. Now what would they have had to do if that was a real hedge? When they made the commitment to buy the fuel in the market at 110, what would they have had to do at the same time? Sell tickets tied to that price. They can't sell tickets tied to that price. How are you going to sell tickets? The next 6 months, you can't sell tickets. You couldn't do it. But that's what they had to do. They had to make commitment like the grain merchant. I'm buying from you, I'm immediately selling it. That's what they had to do. They didn't do that. Now United Airlines, UPS could have done that. UPS, when they bought the fuel 110, they could have made commitments, freight commitments to their clients. Hey, we will give you freight at this price, and they would have locked in a margin. Now the other example I gave you, Vera Sun ethanol. They made ethanol is made from corn. They made commitments to buy corn for the ethanol. That's once again, you can think of some price, let's say $8 a bushel. Price of corn went up, like United Airlines, they were happy. They made commitments to buy at 8. Price is now 12. And what? After the crisis, giving a complete U-turn, prices of the corn. Fell, and now they were bleeding money now. There were trucks lined up with the corn. They had to deliver to them. Their warehouses were full. They couldn't take the corn. Now for this company who have hedged, once again, what would have had to do? And they made commitments to buy the corn, immediately sell the ethanol based on that corn price. They didn't do. So see, here's the thing about hedging. These guys were not hedging, they were speculating. And they thought that they were hedging. In fact, I would call that speculative hedging. They're hedging, but it's not hedging. They're doing speculative hedging. Okay. Now I talk about in the agricultural markets. Okay. The risks that are being hedged are risks that actually exist. Go back to the price. Go back to wheat. Price of wheat going up and down. That's a real risk which exists, which can be hedged. Now, financial risks. Are the financial risks real in the same sense? Yes and no. Banks are in the business, well, banks, what do you call it? They have huge portfolios. Perhaps they have a bond portfolio. Bond prices go up and down. They can hedge that because that's already honest balance sheet. They can do it with the futures and options or whatever. Now those are real risks, real financial risks which can be hedged. And there's something called a synthetic or manufactured risk. Talk for that in a moment. Talk about that. Well, before I do it, yes, the world of financial derivatives, all the different types of derivatives that are available in finance. Forwards, futures, ops, swaps, structured products, mortgage-backed securities, CMOs, CDOs, cars, ETFs. I can talk about this forever, but I want to focus on just one of them. This CDS is called a credit default swap. Stand by. I call it the mother of all derivatives, the credit default swap. Yeah.
Can I ask a question?
Sure.
So, regarding the agricultural economist, which
Yes.
is an example, let's hypothetically say that there was a storm or something like a Katrina that hit it, and the agriculturist is not able to deliver the wheat to the wheat merchants who had promised in a futures market to deliver at say $10, right?
Wait.
So if the agriculturist is going to deliver,
Wait, let's say this, the farmer, the grain merchant.
The grain merchant.
Oh, the grain merchant.
So
Okay.
grain merchant has committed to the farmer to buy it at $9.50.
Oh, they've already taken over. They've already taken the wheat.
They've already taken it.
Yes, they've already taken it.
So then they are not waiting for the farmer to grow it.
No. Once a crop is grown, okay, the farmer has to deliver the wheat to the grain merchants.
So once it is grown, but
Yes.
commitment is grown before the wheat is grown, right?
No. The commitment is made, let's put it this way. Once the wheat is grown, okay, now somebody has to store that wheat.
Yeah.
Okay. The grain merchants do that.
Yeah.
Okay, now the farmers basically want a price at which to deliver the wheat to the grain merchants.
Right.
So the grain merchant look at the Chicago prices, and from that price they quote the farmer a price.
The future price, right?
No, right now.
Okay.
Okay, let's say it's August, right? August. The farmer is prepared to deliver the wheat out to the grain merchant. Okay. But he wants a price. The grain merchant looks at the Chicago prices and then quotes the farmer a price. Once the price is quoted, the wheat's delivered. It goes into the silos, big grain silos. Now you're talking about now the wheat is with the grain merchant. Now you're saying there's something which is hit. You mean-
No. What I assumed was the commitment was given before the wheat was grown, because you also included the banks giving the loans to the farmers.
Okay.
So how did the price was agreed before the wheat is grown so that the banks was able to give the loan?
the banks are basically asked the farmers, are you going to make commitments with the grain merchants?
Yes, correct.
And typically they will commit about 70% of their crop. It actually goes from the farmers to something called the co-ops.
Okay.
Before it goes to the grain merchants.
Right.
Okay. And farmers basically, because of that, there could be a problem with the crop. They
Yes.
won't, about 70% of their crop they will do it this way because of that. And they can also buy insurance. There's also insurance incentive. It's not an exact fit, but the bulk of the wheat is done this way. And they're always going to have that problem. There's a drought, and there's something else. That's why they probably sell about 70% of their wheat. Because if they sell 100% and they don't have 100%, they're in trouble. So they will come in about 70% of the wheat. And the point is that will get them loans from the bank. That's the key point. They get loans from the bank.
But there is a derivative market for future corps to trade for what he's just mentioned. For example, act of God or a storm or whatever. People do make money from such things, right?
Yes, of course. Yeah, the point is that they want quotations. And the futures markets allow these quotes to be made and the risk to be passed on. Okay. The credit default swap. Okay. In simple terms, a credit default swap is basically an insurance policy. So you're buying insurance on something, on basically a bond. Here's an example. Hedging Greek debt with a credit default swap. Here's a bank. Bank is making a loan to the Greek government, let's say it's $100 loan. And they're going to get paid 10% on that loan. Forget this head for the moment. They give them a loan of 100 and they're going to collect 10%. That's just a 5-year or 10-year loan, doesn't matter. The maturity does not matter. Now what happens once the loan is made and the Greek government defaults on the loan? They're going to lose the principal. So what the bank does, it goes to an insurer and says the following: hey, we want to insure this loan to the Greek government. So in case the Greek government defaults, you will give me the $100. And in exchange for this, I'll give you a premium. I'll pay a premium. So now this 10%, which the Greek government pays the bank 10%, they will pay this insurer 1%. And notice I have a dotted line over here. This will be triggered only when this government defaults on the loan. So now, the bank has basically insured its loan via what's called a credit default. This is called a credit default swap. It's an insurance policy. It insures a loan. Okay, now this is a real loan, an actual loan. Okay. Now let's look at this similar transaction. So I call this a real financial exposure. It's a real loan which is being hedged, in a sense, insured. Let's look at the same thing. I'll call it a synthetic loan now. I've just given you one example. This CD has been created from this synthetic loan. Look at the next slide.
Sorry, one more minute.
Yeah.
Why is the default payment of $100? $100 is why does the insurer agree to pay $100? Because the bank has not lent $100 to anyone, and the worst case the bank is going to lose is probably
he is gambling. See, notice over here, okay, the bank, in fact, the bank can do this by itself. That's not, you don't even need this.
Yeah.
This is a pure bet. This is a pure bet on Greek debt. You don't even need this part. But I just did this to show you a synthetic exposure. And hedging is synthetic exposure. But this can stand on its own. And next time we'll show you that. It stands on this one. Now, for example, why would this guy do this?
Yeah.
I'll tell you why.
Yeah.
Okay, that's more important. When an insurance company sells insurance, what is it doing? It's collecting premiums. And this payment will be made only in the event of a default. When I'm insuring a home, what am I doing? I'm collecting premiums. And only have to make the payment if the home burns down. That's what insurance company does. It collects premiums. You know something? That's why Warren Buffett likes insurance. He'll tell you that. The reason why I like insurance is because I'm collecting money over here right now, which I can invest. And this payment I might have to make down the road, I might have to. That's exactly what an insurance company does. It collects payments, which I invest, and I have to make the payment only if the home burns down. That's their job. Okay, now this is a synthetic loan, a synthetic exposure hedged by a same CDS. I call it CDS has gone wild now. This is what happened in the crisis. Banks made mortgage loans and were collecting interest on the loans. Now this is a real exposure, an actual loans being made. Now they wanted to hedge those loans in case they default. They went to an insurer. And of this 10%, they pay them, let's say, 1% premium. Insurer had to pay out in the event the mortgage is defaulted. Only in the event the mortgage is defaulted. Then the insurer said, think of this insurer as AIG, if you wish. I'll put a name to it. They loved it. They, hey, I'm collecting premiums over here. I have to make this payment only in the event this guy defaults. So AIG said, hey, let's do this with this counterparty. And this counterparty says, okay, hey, I will pay you basically 1%, exactly like this one, in exchange for full payment if that mortgage defaults. See, this transaction is exactly as same as this transaction. What's the difference between A and the bank? What's the difference? The bank actually made the loan. Here it's not. Bank actually made the loan. This guy didn't make any loan. How about C? Exactly the same thing. How about B? How about this nonsense? Now they're betting with each other. And this became exploded. I mean, AIG had sold so much of insurance, 100 times the loans. And they were betting, they were hoping that the mortgages wouldn't default. I'll tell you something. This is exactly, think about it. There are hundreds of policies written on a single loan, on a single home. Like this. There's one loan and lots of policies over here written on that loan. Tell me something. There's an incentive to burn the house down. There are hundreds of policies written on one loan, on one home. There's an incentive to burn the house down. These guys don't care. They only collect if the house burns down. That's what's actually happened. Once AIG got a little into trouble, the sharks were in the water, Now they wanted AIG to fail.
So that they collect money.
Started shorting the stock. Shorting the stock is collapsing. They also did it to Morgan Stanley. They started shorting Morgan Stanley stock. And who was it? Johnny Mack, CEO, was begging the Federal Reserve, please stop them from shorting my stock. The sharks were in the water. But this is what happens. See, real loans are fine. Hedging real loans are fine, but the moment you get into the synthetic loans now you can get a sense as to why there are 700 trillion of derivatives. The homes are a tiny fraction, but the amount of exposures, of this, all these things being created, all these gambling taking place. And these guys are calling it a hedge. I mean, if you're going to hedge something, it's got to be a real risk. They're saying it's a loan or it's a crop, something that's real. You can't create this thing and then call it a hedge. So the problem now is, what do you do about this now? Okay, I think I have one more slide which I should talk about. There's no way. The markets are simply too big for the regulators. I remember Alan Greenspan made the statement. He said the only way, Alan, the ex-chairman of the Fed, says the only way we regulators know something is wrong with the banks if somebody inside the bank squeals something's way wrong with it. There's no way we can know that. So I mean, if you're saying regulation, I have no faith that they can do it. It's simply too big. And now all these, they try to have these Dodd-Frank rules, like make it too big to fail and move derivatives into exchanges. That's where I want to go back now and show you what those two slides before. Over-the-counter derivative. Party A, think of it as follows. Party A is making a bet with Party B on some event. Notice over this, there's always a winner and a loser. Think of this as a forward contract on Chevron. Price goes up, one guy wins, the other guy loses. Yet they have to pay each other. The problem with this is there's something called counterparty risk. What's counterparty risk? The inability of the losing side to pay. If this guy wins and this guy loses, he has to collect from this guy. This guy says, no, I can't pay. And this guy's going to lose out. That's what an OTC derivative is. And I'll give you an example in my personal life about this, which is a funny one. An exchange traded derivative. Now, Party A is once again buying from Party B, but the transaction is taking through this exchange. In other words, even though I'm buying from this guy, I'm actually buying from the exchange, and he is selling to the exchange. So this clearinghouse stands as a guarantor the transaction will take place. So this is clearly better than the OTC one. And talking about, as I'm saying, about exposures, I'll give you some idea of numbers. Okay. Between JP Morgan and Morgan Stanley, they have $125 trillion in derivative exposures. And they say, no, that's greatly overstating it. It's not 125 trillion. It's only 30 billion. And here's the problem with that. I am contracting with you, let's say to sell Chevron to you for $100 a share. To sell to you, and I'm making a commitment to buy from you the same stock. So notice now, where I'm concerned, I'm buying from you and selling to you. Our position is zero. They are bought and sold at the same time. Except now that my commitment to you and my commitment to him, there's counterparty risk. So one of you guys fail to honor our obligation, I'm left holding the bag. So even though I think I'm perfectly hedged, I bought from you and sold to you, perfectly hedged, there's counterparty risk. I will not have this in the exchange. And notice over here, with this as I said, it's a $100 transaction here, $100 transaction over here, it's $200 totally. But since they perfectly offset, my position is zero. And so I think I'm perfectly hedged now. When the price goes up, I win with you and I lose with you. So I'm perfectly offsetting each other. But there's counterparty risk. I'll give you an example which happened to me once about counterparty risk. I thought I had a perfect hedge. Remember the 2004 election? George Bush versus Kerry in America. There were people who hated George Bush. So I go to a party and they're saying, there's no way Bush can win this election. The guys that's in the party. So I said, oh yeah, you want to bet on that? So one guy says, sure, I'll bet on that. I'll give you 2-1, he said. I said, wait a minute, I want to make sure that you understand what 2-1 is. I said, okay. It's a $100 bet, 2-1. So if Bush wins, you pay me 200. If Kerry wins, I pay you 100. He said, yeah, that is exactly what it is. Done, I said. $100 bet. Somebody over there says, Mark, I want to take the same bet as he gave him. 2-1, done. And I have two bets now over here. So if George Bush wins, I win 400. If Kerry wins, I lose 200. Right? Lose 200. And by the way, before that I asked anybody else, why should they take the bet with me? Now they figured out, hey, this guy knows something. So they all backed out now. So I was telling my wife on the way home, I said, look at these fools. Don't they know what the odds are in the election? It's even money on the election. So I go home and place a $300 bet that Kerry would win. In the political market. And guess what? I'm very happy now. I can't lose. I said, if Kerry wins, I get $300 over here, and I pay them $200 over there. Because they bet in Kerry, right? If Bush wins, I collect $400 over here, and I lose $300 over here. So no matter who wins, I'm up $100. I had what I call the perfect hedge. Guess what happened?
Yeah.
Bush won. So I lost by $300 over here, right? I bet Kerry over here, $300 I lost. I couldn't collect on this side. Counterparty risk, writ large. Man, a perfect hedge. As I told her, the only perfect hedge is in a Japanese garden. There's no such thing as a perfect hedge. So that's what counterparty is. See, what's a perfect hedge turns out a perfect disaster. That's what happened in the crisis. They thought they were, and even JP Morgan, they thought they had a perfect hedge. They're gambling here. First they're taking they're gambling over here, and then they're hedging on that gambling. So that's why I call it a speculative hedge. So that's basically, I mean, my talk over here. And as I said, regulation, we don't know how to, we don't know how to do it. The problem is, you've got to make these institutions smaller. forget this too big to fail. They should be, make them so small that they can't fail. And won't hurt everybody else. And there are issues about letting the banks have, keep a larger capital base. I don't believe that, because if you force the banks to have a larger capital base, they're going to take even more risks to pay off that. In other words, their cost of capital is going to go up. And when the cost of capital is going to go up, you're going to take bigger risks to pay off their capital. The thing is that we have to find some way to make these guys fail without hurting us. And that's the $1 million question. How you can do that? That's it. Okay. Any questions? You can go on move. Go way over. 115 minutes. Maybe you can go and have a drink. I'm sorry.
I do have one question on the regulators, just to better understand. So
Sure.
all those numbers were public, meaning if I read the balance sheet of all those banks, can I just do a math of all the derivatives out there and what's the risk, et cetera, from the regulator's point of view?
I know the regulators, here's the example. As I said, these guys are 125 trillion in derivatives, but their net is just much smaller than that. It's like this. They are $100 long over here and 97 short with this party. So 100 long, 97 short. So the total position is 197. But they are reported as 300 minus 97. So the question is, I mean, do the regulators know that? Yes, they know that. But now it's the politics is involved in this. They can't tell the bank that you can't do that.
Why?
They can't, because it's not, what do you call, illegal to do that. The 100 long 97, I can be long and short at the same time. But the exposure is 197 and not 3. What's important, it would be nice for the public, the actual investors who know that, not the regulators. Because if I know where those bets are taking place, I can guarantee you that those stock prices would collapse. Not collapse, because now they have become much riskier. In fact, right now, the banks are taking the beating. If you look at their stock prices, the public now simply doesn't trust them. That's the biggest problem. The biggest problem for the banks is that they've lost the faith. And I said always, trust, not money, is the currency of finance. And once you lose that trust, it's going to take some time before the trust is recovered. That's the biggest problem. Not these derivatives and all. It's the trust that's been lost. Now look at the Morgan Stanley, the Facebook IPO. Think about it. Sold it at 38. The luckiest guys over there was Facebook. They got $38. The guys who bought the stock, now it's worth 26. In 1 week, it's worth 26. And now Morgan Stanley did a very good job where Facebook is concerned. That's their job, to get the best price for the company. What do they lose now? What did Morgan Stanley lose? Trust now. You think when Morgan Stanley says, Yapta, the next one is worth $25, anyone's going to believe them? I won't believe them. How they've got to recover that loss? They lost a face. They did a good job with Facebook, but they have lost the faith of the investor. Certainly mine, I don't know about the other people. I won't take their word for it. If they say General Motors is worth $40 a share, I'm not going to believe it. Where did they come up with this number? 38 for Facebook, now it's 26. 1 week later, of course the stock market has fallen, fair enough. Part of that fall is the stock market fall. What is it, 30%? How much? From 38 to 26, what's the percentage? 33%? Stock market dropped no more than 5%. That's the problem with Wall Street. It's the lack of faith, lack of trust. Yeah, JP Morgan also. He says he was hedging. What hedging? Now the loss is 4 billion now. And counting. And of course, the stock has lost $20 billion in value because of this. Anyway, good seeing you, good having you guys, and hope you learned something.